Welcome to the Deep Dive. We are putting on our Talk Ticker's armor today, diving deep into the complexities of WhiteFiber, WYFI.
Yeah, WYFI. And this analysis focuses entirely on their second quarter 2025 earnings call.
Which was a pretty big deal, right? It was their very first call since, successfully spinning out as a standalone public company.
Exactly. And if you were following the market that day, you saw an immediate paradox unfold, didn't you?
You really did.
Yeah.
So our mission here is to understand exactly why WhiteFiber stock just soared. I mean, it hit an all-time high in the days following the call.
Even though they missed consensus estimates on profitability, that's the key.
Right. So we need to kind of extract the strategic vision, the nuggets, that convince the market to basically overlook the immediate bottom line pain.
Let's do it.
Okay, so let's unpack this high-velocity reaction. The moment the results dropped after hours, the market just started buying.
Instantaneous.
We saw the stock spike, 11.74% the next trading day? Volume nearly doubled. Huge volume.
And the momentum didn't just fade either. By the end of the week, this newly public company had seen a share price bump of over 25%.
Incredible.
It's a classic AI growth scenario, really. But the numbers themselves, they tell a story that, well, it requires some explanation.
Definitely.
On the top line, look, they absolutely delivered. Total revenue hit $18.7 million.
Which is a massive 48% increase year over year. Huge growth.
Yeah, and that comfortably beat the street consensus, so check mark there.
Now, for the flip side, which is why this is such a fascinating puzzle, right?
Yeah.
The profitability got hit hard.
Oof, yeah.
Their GAAP EPS, that's generally accepted accounting principles earnings per share, the sort of official view of their profitability.
Right, the standard measure.
It came in at a loss of 24 cents. That missed consensus estimates by a pretty significant $1.17.
17 cents is a big miss there.
All right.
And furthermore, their adjusted EBITDA, that essential measure of operational health.
Earnings before interest, taxes, depreciation, and amortization. Always got to spell it out.
Yeah. Huh. Right. Well, that dropped significantly, too. It fell from $7.0 million in the prior year quarter to just $3.3 million this quarter. Big drop.
Okay. So we have a clear, pretty dramatic revenue beat, earnings miss scenario.
No question.
And the market signaled decisively that, look, 48% growth and high exposure to this, burgeoning AI infrastructure market. Well, that matters far more right now than current net income.
Exactly. The market voted with its feet, or rather its buy orders, so the focus immediately shifts to the profitability question, doesn't it?
It has to. What drove that massive decline in adjusted EBITDA and the, $8.8 million net loss? It seems kind of counterintuitive when the company's growing that fast.
Yeah, you'd expect some operating leverage, maybe.
Which brings us squarely to the operational expenses. We saw OpEx surge, particularly general and administrative cost G&A. That jumped to $15.5 million from $10.2 million a year ago.
Wow, quite a leap.
That's where the market's focus needs to be, I think. Is this a structural cost problem, or is it just a temporary hangover from the spinoff?
Well, management was actually very detailed on this, and I think this clarity is probably part of what the market bought into.
Okay, what did they say?
They attributed the profitability gap and that G&A jump almost entirely to the scaling costs associated with becoming a standalone public entity post-spinoff, setting up shop on their own.
But how often do companies promise those one-time costs will just disappear? I mean, you have to be a little skeptical here, right?
Sure, skepticism is healthy.
What specific proof did management offer that this G&A is actually going to normalize? I mean, a $5.5 million one-time hit isn't exactly small change for a company doing $18.7 million in revenue.
No, it's significant. But they broke it down. That $5.5 million specifically included one-time milestone stock-based awards and non-recurring prep costs for the IPO itself.
Okay. Specifics help.
And management also stressed that they're now replacing expensive consulting fees, which they were leaning on right after the spin, with new, presumably cheaper, internal headcount.
Bringing it in-house.
Exactly. So the expectation they set is pretty clear. This expense intensity, it will fade. And fade dramatically.
Oh, okay. And maybe the market believed them because the underlying unit economics still look really resilient if you sort of strip out the OpEx noise.
The gross margins are fantastic.
Yeah, really good.
They are outstanding, which is the necessary counter-narrative here. Look at the cloud services segment that generated $16.6 million in revenue.
And the margin.
Delivered a 61% gross margin. 61%.
Wow.
And the newly disclosed colocation segment debuted strongly at 60% gross margin.
So the core business is profitable at the gross level.
Right. This demonstrates that once those, corporate overhead costs normalize, a significant chunk of every future revenue dollar should, theoretically, drop straight to the bottom line.
They also gave us a pretty concrete picture of their current operational scale, kind of beyond the headlines.
Yes, they did. The run rate revenue for their existing GPU cloud services is already around $88 million annually.
$88 million. That's a solid base.
And if you include the revenue derived from contract payments from Boostroid, which shows up kind of weirdly in other revenue, that annual GPU-related run rate actually exceeds $90 million.
Okay, so $90 million plus. That's a strong existing foundation, even before you factor in these massive colocation expansion plans they're talking about.
Absolutely. It's not just future promises.
Okay, now let's transition maybe to the strategic storyline, because that's what truly seemed to capture investor imagination.
Yeah, the narrative.
Management kept emphasizing their position as a pure-play, independent AI infrastructure company. What exactly is their key differentiator in what's becoming a hyper-competitive field?
Well, the differentiator, they argue pretty convincingly, I think, is controlling the full stack. Meaning they don't just offer GPU resources like some cloud providers. They own and operate the physical data centers and the cloud resources they host inside them.
The whole chain.
The whole chain. For major AI model training customers, this integrated control means, supposedly, guaranteed reliability and optimized performance. That's what sets them apart from, say, generic cloud providers or simple real estate landlords just renting out space.
Okay. And the competitive advantage they really hammered home was speed and capital efficiency, driven by this retrofit model. This is where it gets really interesting, I thought.
That's the core thesis the market is rewarding right now.
Absolutely. Take the Montreal 3 project for Cerebras as the perfect case study.
The mattress factory one.
The former mattress factory, exactly. They acquired it, quickly converted it into a sophisticated, highly powered Tier 3 data center for a 5-megawatt IT load.
And the timeline.
Get this. They took control in late April, and they expect to begin recognizing revenue in October.
Wow. Less than 6 months from getting the keys to actually earning money from it.
Incredible speed.
Can we quantify what that 6-month turnaround actually means financially compared to, say, building a new data center from scratch? Well, that speed is their moat, right? They estimate the retrofit strategy makes them 2 times faster.
Twice as fast.
And approximately 40% cheaper than constructing new facilities from the ground up.
40% cheaper. That's huge.
It's massive. And in the world of AI, time is the enemy, right? Because GPUs and specialized hardware, their relevance decays exponentially fast.
Technology moves quick.
So if you can get the latest NVIDIA hardware deployed, say, 18 months faster than the competition, that speed itself commands a premium from AI clients who are just desperate for capacity now.
Makes sense. Speaking of demand, the North Carolina site, NC1, sounds like a complete frenzy over there. They actually used the phrase horse race to describe the demand.
They did. Phase 1 is 24 megawatts, and the demand is exceptionally strong. Management is literally in discussions with multiple highly creditworthy parties simultaneously.
And the staggering part.
The staggering part is that customers aren't just looking to take that phase 1 capacity, they're asking to upsize. One party in particular has apparently expressed interest in taking the entire 99 megawatt future build out.
The whole thing. 99 megawatt.
The whole future shebang. Yeah.
Okay, but incredible demand like that also introduces massive execution risk, right?
Yeah.
And financing risk.
Yeah.
Especially for a newly public company.
Huge risks, no doubt.
How are they mitigating that? How are they securing the enormous capital required for a potential 99 megawatt build?
Oh, yeah, good question. And this is where their strategic financing approach really shines, or at least that's the plan. They're using customer commitments, things like security deposits, escrow arrangements, even OEM backstops.
To strengthen their financing profile. So the customer's commitment basically acts as collateral.
You got it. It de-risks it for the lenders.
And what are the specifics of that financing they're targeting for NC1? It sounded pretty aggressive.
It is capital efficient and, yes, aggressive. They're targeting high leverage debt financing, think 75% to 80% loan to cost.
75 to 80% LTC.
Wow. Which means they only have to put up maybe 20% to 25% of the equity themselves. That reserves their own capital for other projects down the line.
That's cheap debt, relatively speaking. And that's only possible because of The creditworthiness of these big potential customers, presumably.
Precisely. They anticipate the pricing for that debt to be somewhere in the high 200 to mid 300 basis points over SOFR.
SFR being the secured overnight financing rate, the benchmark.
Right. So that pricing suggests they're getting high quality debt that's deeply competitive, and it's all supported by those strong customer contracts they're lining up.
Okay. And the success of this NC1 pitch seems to be driving future growth too.
Correct. They confirmed expansion opportunities are being actively pursued in new markets. Think Arizona, Texas, New York.
Following the demand.
Exactly. This isn't speculative building. They're being guided by firm customer demand that came directly out of the conversations they were having around the NC1 build itself. They're prioritizing capital based on concrete customer interest.
Smart. Okay, so beyond the huge colocation pipeline, they also have some immediate revenue potential just sitting in existing inventory, right?
They do. They hold about 700 GPUs that are not yet under contract.
And these aren't old chips.
No, this is high-value hardware. We're talking 576 H200s and a mix of the newer B200s and GB200s. Very cutting edge.
Add to the value.
Management estimates these assets alone represent about $15 million in annual revenue potential at current market pricing. So, nice little kicker there.
But there is a very critical hurdle right now with those NC1 contracts. Management stressed they need to formalize these in the coming weeks. What's delaying these high-value, high-leverage deals from actually getting signed on the dotted line?
Yeah, this is crucial. The delay stems directly from the rapid advancement of NVIDIA hardware itself. It's almost ironic.
How so?
Customers are pivoting. They want the absolute latest, sometimes even unreleased, B200s and GB200s.
Ah, the cutting edge moves fast.
It moves really fast. And this isn't just a simple chip swap. Switching chips changes the power density needed, the cooling requirements, the physical layout and design of the data center halls.
So the customers are pivoting mid-negotiation, which requires a complete redesign and then a recontracting process.
Yeah.
That sounds like it introduces significant execution risk, doesn't it?
It absolutely does. Management admitted this might incrementally increase the build costs beyond their initial, $8 million per megawatt estimate.
Costs could creep up.
Could creep up. They're essentially managing a moving target that's dictated by NVIDIA's launch schedule and the customer's eagerness for the absolute newest tech.
Okay, so the street is now watching very closely to see if they can effectively manage these complex pivots without blowing past deadlines or budgets. That's the key risk now.
That's the near-term execution hurdle, exactly.
Which raises an important question for investors then. The current sentiment is clearly, let's say, constructively bullish on the top-line trajectory. Right. Growth story is intact.
Yes, definitely bullish on growth.
But the street remains, as you said, cautious on expense intensity. Needham reiterated a buy rating after the call, which is positive. But what are the two key catalysts we are watching for now? What proves the bull case?
Two things, mainly. First, visible bookings. That means the formal signing of those multi-year HPC leases for NC1. Get those deals inked.
Show me the contract.
Show me the contracts. And second, proof of OpEx control. Those 60% gross margins are beautiful, right? But they need to show they can actually translate that into net income once the sort of one-time IPO hangover costs are fully flushed out of the system.
Right. Margin needs to flow through.
Yeah.
Which sets up a truly compelling thought experiment for capital deployment, maybe leading us to our final segment here.
Right. And as always, please remember, this is not financial advice. Super important disclaimer.
Definitely not advice. We are simply laying out a high-risk, potentially high-reward idea based on the confluence of data points we've just analyzed.
A thought experiment.
Exactly. A thought experiment. So the thesis foundation seems strong. The stock's momentum is based purely on the AI growth story and their strategic positioning. The asset control, the deployment speed, we covered that.
Yep.
However, we have that massive profitability gap we discussed, and the crucial, often overlooked fact that the original parent company, Bit Digital, ticker BTBT,
Still holds a colossal stake.
a colossal 71.5% stake in WhiteFiber.
Right. And that controlling stake creates a really complex financial dynamic. The parent company, BTBT, is heavily exposed to the execution risk and the cost build-out risk of the subsidiary, WhiteFiber.
Without the pure play narrative that WYFI currently enjoys in the market.
Exactly. BTBT is seen more as the parent with potential baggage.
Okay, so the paired trade idea we might pitch to the hypothetical investment committee is this. Go long WhiteFiber, WYFI, and simultaneously short the parent company, Bit Digital, BTBT.
Long WYFI, short BTBT. The rationale is pretty sharp, I think. This trade aims to capture the market's clear enthusiasm for the pure play, high velocity AI asset, which is WYFI.
While using the parent company, BTBT, as kind of an execution hedge
Mm-hmm.
and a proxy for all that internalized complexity.
Right. If that massive NC1 build-out proves more expensive than planned, or runs into unforeseen integration difficulties, or maybe if WhiteFiber needs to raise more capital down the line,
That dilution risk or that cost pressure.
is most likely to be internalized or reflected, at least partially, by the controlling parent entity, BTBT. Its stock might feel that pain more directly than the growth story subsidiary.
Okay, so you're essentially buying the growth and speed, WYFI, while hedging the significant risks associated with scaling with those public company costs, and with that big 71.5% ownership structure that ties the parent to the subsidiary's inevitable growing pains.
It's basically a bet on the separation premium that the market values the clean, pure play story higher than the consolidated entity with all its complexities.
Interesting idea. It allows you to invest in the strategic moat while hedging the financial and execution complexity that comes with these high-growth, newly public companies, especially ones still tied so closely to a large controlling parent.
Precisely. A structural arbitrage play, in a sense.
Okay, so to summarize everything, WhiteFiber successfully sold the market on its high-velocity, capital-efficient retrofit strategy. That definitely captured the market's imagination.
No doubt. The market immediately rewarded capacity and speed over profitability this quarter. That was the clear message.
So the focus now shifts entirely, as we said, to cost discipline and converting that high-value NC1 pipeline into finalized, credit-backed, multi-year leases, even despite the changing hardware landscape from NVIDIA.
Execution, 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 and cost control.
Right. And here's maybe a final thought for you, the listener, to chew on. If time is truly the enemy of technology, as management suggested, and they're leveraging their speed to capture massive market share,
How long is an acceptable window? How long can a high-growth AI infrastructure player like this sustain negative profitability, especially if the cost of capital environment were to shift, get tighter?
good question. What's the limit when growth is 48%? And when do investors finally start demanding that lovely 60% gross margin actually shows up in the net income line?
A question that really defines the line between aggressive growth and building a truly sustainable business long-term.
Something to ponder. Thanks for diving in with us today.